Hello, and welcome to the Singer Lewack training on ASC Topic 842, Leases. I am Jeremy Dillard, an audit partner in the Los Angeles office, and I'll be joined by David Finkelstein, an audit director based in the Irvine office. Here's the agenda for this training. We'll start with an overview of ASC 842, and then cover the new concepts introduced with a large portion of the training spent on the initial measurement, that is, how to record leases under ASC 842. And another large portion focused on lease modifications and concessions. Finally, we'll wrap up this training with some miscellaneous lease issues. So let's get started with ASC 842. First, we should level set on some of the basic concepts about ASC 842 and lease accounting. First, ASC 842 applies to all industries, and this is because there's not really any industry that cannot have leases. Under ASC 842, leases will see a significant change for those leases that were previously classified as operating leases, because now they will be capitalizing the future lease payments on the balance sheet. However, the previous expense recognition patterns for operating and capital leases remains mostly consistent with ASC Topic 840, the former GAAP rules for leases. However, the lessors will have much smaller changes with the elimination of the leveraged lease model that was previously allowed under ASC 840. Also, there used to be specific GAAP guidance for leases that involved real estate, such as a lease of land and building or a lease of land, building, and equipment. Those rules are now gone. Also, there's some minor changes to the rules for sales leaseback arrangements. We should also mention there's some scope exceptions from ASC 842. It does not apply to intangibles, biological assets, and inventory. Also, there's an optional scope exception for leases that are 12 months or less. ASC 842 creates a new right of use, or ROU, model to recognize the lease asset. Once an entity determines that a contract meets the definition of a lease, then it has to classify it as either a finance or operating lease. Both finance and operating leases are initially measured the same and will be recognized on the balance sheet for the same amount, but the recognition and presentation is different on the income and cash flow statements. This chart summarizes the various lease models under ASC 842, first showing the lessee models and then the lessor models. For the lessee, the leases are classified as either finance or operating, with the ROU asset and lease liability being recognized on the balance sheet for most leases and similar expense recognition patterns as the previous GAAP guidance in ASC Topic 840. For the lessor, the leases are classified as either sales type, direct financing, or operating, with very minor changes from the previous GAAP guidance in ASC Topic 840. Now, for those listeners who are familiar with the new revenue recognition rules in ASC Topic 606, you may recall that the fundamental concept is control. Well, ASC 842 follows that concept because the right of use model is based on the lessee having control of the leased asset, and because of that control, recognizes a ROU asset and lease liability on the balance sheet. But control isn't the only requirement to determine whether a contract is a lease. It also needs to identify the specific asset that is being leased. For example, if the contract doesn't identify a specific car by the vehicle identification number, or VIN, then it may raise questions about whether the lessor could substitute the vehicle with a similar one, and if that's the case, then it may be more appropriate to account for the arrangement as a service contract. Also, the scope of ASC 842 is mostly going to be applied to fixed assets. So with the starting point being whether the contract meets the definition of a lease, an entity should evaluate whether the contract conveys the use and control of an identified asset for a period of time. One consideration point in this process is whether the supplier has a substantive right of substitution, which, simply put, means the lessor has the contractual right to swap out leased assets. If the lessor can swap out assets, then it may be deemed a service contract under GAAP, and that means accounting for that contract would not fall under ASC 842. When an entity is trying to determine whether a contract is a lease, it will depend on terms. First, the contract needs to convey the right to derive benefits from the use, holding, or subleasing of an asset during the contractual period. Keep in mind that the term, quote, economic benefits is fairly broad term. Similar to ASC Topic 606, separate contracts negotiated as a bundle need to be evaluated as a bundle.
We are now going to discuss transition methods and the practical expedients related to transition. For the effective dates of transition, public companies would be expected to adopt this in years beginning after December 15th, 2018, which means your 2019 year ends. Public not-for-profits, which are mainly conduit, debt, obligor not-for-profits, would start with years beginning after December 15th, 2019, so your 2020 year ends, and all other entities, private and whatnot, would need to adopt this with years beginning after December 15th, 2021, which means your 2022 year ends, which means January 1st, 2022 would be your effective adoption date. Now, 842 allows for different transition methods. The first one to consider is if you are not presenting comparative financials, you would only adopt it in your reflective year. So for private companies, your 2022 year-end financials. If you are presenting comparative financials, there's a couple different options available under 842, as well as allowed under the additional transition method, which was granted later. Now, their first method is the original transition, which means if you're presenting 2 years comparative, in the year of adoption, you would reflect your impact, plus you'd go back to the prior year and reflect that. So the 2 comparative periods you were presenting would be reflective of 842. So if you adopted in 2022, you'd go back and restate 2021 to reflect your 842 or lease adoption. The other method is, if you're presenting comparative again, is to present it as the year of adoption would be under the new method of 842. And then the prior period would be under the original as presented, which would be the old lease standard. And you'd basically have an adjustment as of January 1st, 2022, booked or shown. Practical expedients allowed under 842 as it relates to making the transition easier. We have the modified retrospective approach with hindsight. This allows for the evaluation of renewal and purchase options on existing leases. We have the significant relief provisions that relate to policy elections, where you have no required reassessment of expired or existing contracts, are whether they are or contain leases, the classification of any expired or existing leases, and the consideration of initial direct costs for expiring or existing leases, and leverage lease treatments are still grandfathered in. For the package of practical expedients, if you elect this package of practical expedients, you are not required to reassess your prior conclusions under the previous lease guidance as it relates to how pre-existing contracts are considered or whether or not they contain a lease, whether or not pre-existing leases should be classified as an operating or finance lease, and whether initial direct costs capitalized for a pre-existing lease under 840 qualify for capitalization under 842. So if you, as a lessee or lessor, elect the package of transition practical expedients, all the expedients in the package must be applied to all leases. So for hindsight, this practical expedient means that if you elect it, you would use hindsight to determine the lease term on the date of initial application and leases using the hindsight as well when you evaluate your assets for potential impairment under FASB ASC 360. So you would go back and to the prior year and reassess then in determining whether or not you would have a renewal that you would apply and or consider. So in 2022, upon adoption, if you did not know in 2021 whether or not you would renew, but in 2022 you made that decision, then you would go back and apply it as if you had made that decision in 2021 and calculate it then. If you have land easements and you elect this practical expedient, you do not assess whether pre-existing or expired land easements were not previously accounted for as leases under 842 or were considered to contain a lease under 842. However, you do need to assess whether the land easements entered into or modified after the date of adoption contain a lease under the new lease guidance. So in your transition stage, there are certain considerations that you need to make, and that is basically working on developing a transition plan that considers your impacts on your internal control over financial reporting, your internal budgeting and planning process, potential impacts on taxes, if there's any compensation arrangements that the recording of these leases may impact, as well as if there's an impact on your debt covenants or other potential contracts, how you may be communicating internally or externally relating leases or your financial position that could be affected by 842. If you need to develop additional IT systems and data management over the adoption of 842 and potential impacts there, as well as looking at lease structure strategies for future leases to determine how you might want to restructure them or structure them going forward for new leases as it relates to 842 and the required disclosures and capitalization as necessary. Now, as part of the new lease guidance, you do have to make certain accounting policy elections as part of your adoption. So there are some certain formal elections that are required. The first one is to consider whether non-lease components should be included or excluded from your lease base calculation. So you would determine whether or not you want to consider non-lease payments portion of the leases as part of the overall package or treated separately and not capitalized and expensed as incurred. You have to make a policy election related to short-term leases. So any lease, you cannot recognize a right-of-use asset or the lease liability for short-term leases under 842. Instead, you will record them in a manner similar to your leases under the legacy guidelines. What's considered a short-term lease is one that has a maximum lease term of 12 or fewer months and does not include a purchase option that the lessee is reasonably certain to exercise. And this does also not include month-to-month leases, which we will discuss later. You also have to make a policy election around discount rates. So for non-public business entities, you can make an election to use a risk-free rate in lieu of determining an incremental borrowing rate when determining the present value of your lease payments for the purposes of calculating your asset and liability. While it's not expressly stated in 842, non-public business entities should also apply a consistent accounting policy when determining the classification of a lease. There's also a formal policy election required as it relates to the presentation of right-of-use assets and lease liabilities. So as a lessee, you can either present the line items on the balance sheet for finance and operating lease liabilities and right-of-use assets, or you can disclose in the footnotes the balance sheet line items where each type of asset and liability has been recognized. So you would either do it on the balance sheet or in a footnote, but you do need to separate out your finance and operating lease liabilities and related assets. The commingling of right-of-use assets for operating and finance lease or lease liabilities or operating and finance is prohibited. Again, you would have to disclose it. There are other informal policy elections, judgments, and internal control processes that do need to be considered as part of your adoption. The first one is what's considered the term major part. So that's working on establishing an accounting policy by class of asset to determine what constitutes a major part of the economic life of the underlying asset. You would need to then use this to evaluate whether the lease term is for a major part of the leased asset's economic life for future purposes of lease calculation. There's also what's considered substantially all, which is an accounting policy by class of asset to determine what constitutes substantially all. So companies would need to do this when they're evaluating whether the present value of the lease payments amount to at least substantially all of the fair value of the underlying asset for purpose of the lease classification. Another area is specialized nature. So this is determining an accounting policy that defines the type of assets and if they're considered a specialized nature for purposes of assessing lease classification. This policy is also applied in evaluating the reasonability of certain principle and determining the lease term and effect and assessing the effects of purchase options. Reasonably certain is to consider the developing guidelines to evaluate whether it's reasonably certain that a renewal option, termination option, or purchase option would be exercised. So the guidelines for developing this would be to consider all relevant factors that create an economic incentive for the lessee to exercise the options, and that includes consideration of the market, the asset, the entity, and other contract-based factors. Another area is their incremental borrowing rate. If there's a rate implicit in the lease and it's not known or calculable, the lessee should discount future lease payments using an incremental borrowing rate. Under 842, an incremental borrowing rate is defined as a rate of interest that the lessee would have to pay to borrow over a similar lease term with a similar security with the funds necessary to obtain an asset of a similar value in a similar economic environment. So the lessee would need to consider whether or not they need to modify existing processes to estimate incremental borrowing rates by class of asset.
Okay, now that an entity has determined that it must adopt ASC Topic 842 and the available practical expedients, let's talk about how to classify the lease. Keeping the approach simple, whether to classify the lease as operating or not. This slide presents the criteria for not having operating lease treatment. So a yes answer to any of these questions will trigger finance lease accounting for lessees or sales type lease accounting for lessors. As I cover these criteria, you'll see they are similar to the old rules under ASC Topic 840. First, is there a transfer of title? If the asset will ultimately become the property of the lessee, then it's not an operating lease. Second, is there an option to purchase the leased asset that is reasonably certain to be exercised? This is similar to the old bargain purchase option in ASC Topic 840, but now the threshold of, quote, reasonably certain makes it a higher bar. And we'll discuss this later in more detail. Third, is the lease term a major part of the remaining economic life of the asset? Similar to the old rules in Topic 840, an entity excludes this criteria if the lease starts near the end of the economic life. This is similar to the old rule that had a 75% bright line threshold. Fourth, does the present value of lease payments, including residual value guarantees, equal or exceed substantially all of the fair value of the asset? This is similar to the old rules that had a 90% bright line threshold. Lastly, is the asset customized or specialized so that it has no alternative use to the lessor? Again, you only get to apply operating lease treatment if the answer to all of these questions is no. So, based on the previous slide, you may be thinking that ASC 842 is easy, and you can just apply the same criteria as the old rules in ASC 840. And the answer is that yes, you can use them, but not quite as bright line thresholds. Under ASC 840, there were many opportunities to create highly structured leases. Specifically, many leases were designed so that the present value of the lease payments would be 89.9% of the fair value. Because the FASB has taken a more principles-based approach to the classification in ASC 842, An 89.9% present value would not necessarily result in an operating lease classification. However, this would depend on an entity's accounting policies, which should be consistently applied. So the FASB did not intend for applying ASC 842 to be overly burdensome and included several practical expedients or shortcuts. One of them is the portfolio approach, which is available when there's a group of lease agreements for nearly identical assets with nearly identical terms. This is likely to be used when leasing copiers or vehicles. Keep in mind the portfolio approach may be used as long as it doesn't change the result if each lease was evaluated individually. In other words, it's a shortcut. Another issue raised to the FASB was about mirror accounting treatment. That is, can the lessee and lessor have different accounting treatment for the same lease agreement? The answer is yes. This is because there's some assumptions and other judgment calls made in applying ASC 842 to a lease agreement. For example, the lessee may not know the implicit rate in the lease and use the incremental borrowing rate that's significantly lower, resulting in a much higher present value amount. As you may recall, when I previously discussed the new criteria for a purchase option, I mentioned that we cover the, quote, reasonably certain term. You need to bear in mind that reasonably certain is a higher threshold than probable under ASC Topic 450 contingencies. If probable was about 75% to 80% likelihood of occurrence, then reasonably certain is closer to 95% to 99%. The way to view it is that the alternative is so costly that the lessee would exercise the purchase option to avoid these costs. Here's a couple scenarios to illustrate the concept. In the first scenario, Entity P leases a tractor that requires a residual value guarantee of $25,000 for an asset with a purchase option to pay the fair value of $20,000. As Entity P would be reasonably certain to avoid paying the extra $5,000, the lease would be classified as a finance lease. In the second scenario, Entity U leases an airplane with a very extravagant upgrades that add significant value and have an estimated life that goes 20 years past the lease expiration date. However, the lease wasn't updated for these improvements to the plane, and Entity U has a purchase option to pay the normal fair value for a plane without the upgrades. That is, there's a heavy discount when exercising the purchase option. Since Entity U can exercise profit from this oversight in the lease agreement by exercising the purchase option and sell the plane, it's reasonably certain that the purchase option will be exercised. So the third criteria is about useful lives and whether the lease term is a major part of the remaining economic life of the asset. However, questions were submitted to the FASB about how to handle a situation where a lease includes multiple assets and the assets have different remaining economic lives. An example of this would be a lease of a building, and that lease includes all the machinery and equipment inside the building. In those situations, the FASB decided the entity should separate the lease components if the lessee can benefit from the leased asset either on its own or together with other resources, and the leased asset is not highly dependent or interrelated to other assets identified in the lease agreements. If both of those requirements are not met, then the entity should apply the predominance principle and use the estimated life for the predominant asset in the lease. Now, as you may recall, the fourth criteria for lease classification was about lease payments. However, the present value calculation includes both the lease payments as well as the residual value guarantee. So let's walk through an example for a residual value guarantee. A company leases equipment for 5 years, and the lease states that the residual value will be $140,000 at the end of the lease, and that's based on 3,000 machine hours. However, the company expects to use 4,500 machine hours during the lease, and the fair value will be $135,000, which means the company expects to pay $5,000 for that residual value guarantee. So, for the present value calculation, the company includes the $5,000 for the residual value guarantee in the lease payments and includes $140,000 residual value when determining the amount that is substantially all of the fair value. Now, the FASB did include an accounting policy election to get out of ASC Topic 842, which is for short-term leases. If an entity leases an asset for less than 12 months and there's no purchase option that is reasonably certain to be exercised, then the entity can elect to account for the lease as a lease expense that's recognized on straight-line basis. Entities can make this accounting policy election on an asset class by asset class basis. Also, keep in mind, this would need to be disclosed as a significant accounting policy.
So the next process is to review the components of a contract, and we go through 4 steps as part of this process. The first one is to identify the separate lease components. So when you're looking at your leases, you're looking at whether or not there's multiple assets built into that lease agreement. So do you have land, building, equipment, installed improvements, furnishings? Those are all examples of multiple assets. So you need to understand the pieces of the lease itself. You need to start by looking at the lease component. So that in itself is the right to use the underlying asset, and it's considered a separate component if you can benefit from the use of that underlying asset either on its own or with other resources that could be readily available. And that underlying asset is not highly dependent or is not highly interrelated with other assets in the arrangement. There's also the non-lease component as a piece, and that's an activity that transfers a separate good or service to the customer as is considered a non-lease component. Examples of this are if there's maintenance services that are consumed by the customer and bundled with the lease in the contract, those would be considered separate non-lease components because the performance of the maintenance transfers a service to the customer that is separate from the actual right of use asset. And there's a third component or piece, which is considered non-components of leases. And that's any activity in a contract that does not transfer an actual good or service to the end lessee. And that's not is neither considered a lease component or a non-lease component. For example, in the contract, payments made by the lessee for property taxes or insurance that covers the supplier's interest or the lessor's interest are not considered to be components of the contract, and those would be considered non-component for this 842 adoption. So we look at identifying separate lease components. We look at an item that is considered an underlying asset is a separate lease component if both the following criteria are met. First, the lessee can benefit from the right of use either on its own or together with other resources that are readily available to the lessee. And B, the right of use is neither highly dependent on nor highly interrelated with the other right to use underlying assets in the contract. When we look at this, readily available resources are considered goods or services that are sold or leased separately by the lessor or other suppliers to the lessee, or resources that the lessee already has obtained, and that could be from lessors or other transactions or events. Now, in terms of this, land is also considered a separate lease component, but it is considered an exception. A right to use land must be separated from the rights to use of other underlying assets, such as from the right to use a building that sits on top of the land. So unless the effect of separating the land is insignificant to the resulting lease accounting, you would not separate it in this instance. Now, for non-components, we consider these excluded contract components. So when you're looking at this, items that are not components of a contract and do not receive an allocation from the consideration of the contract are things such as administrative tasks in which you would set up the contract or initiate the lease that does not specifically transfer a good or service to the lessee, or items that are reimbursed or payment of the lessor's cost. Again, as we previously mentioned, items such as paying their insurance or property tax. as part of the lease is what's considered a non-component. For identifying the separate non-lease components, non-lease components in the contract will generally represent some sort of service that the lessee is paying for in the contract and the lessor is providing to the lessee in addition to the lease component. So, for example, if you have a right-of-use equipment and the lessor also provides regular maintenance of the equipment throughout the contract, that's an item. Another example is a transportation vehicle, airplane, ship, or truck. When the lessor also provides either operating personnel to operate the vehicle or for the lessee throughout the contract, such as if you lease an airplane and the pilot is provided as part of that lease service. Right to use of an oil, gas, or mining rig, where the lessor also provides the crew to man and operate that rig throughout the contract. For a manufacturing facility, if the lessee provides the material and labor needed to produce a product for the lessee. If you have several floors of an office building, when the lessor also provides maintenance services to clean the building lobbies, maintain elevators, etc., also what's considered CAM or common area maintenance. We do have a practical expedient in this area. So if you elect by asset class to choose not to separate the lease components from the non-lease components, you can instead account for each separate lease component and non-lease component with that lease as a single component. So again, you would do this by asset class. So all your buildings, if you elect to treat rental buildings by this case, you would all classify them together and treat them the same. But you could have a separate election to elect to treat other areas such as manufacturing equipment or oil rigs separately from each different class, but each class in itself has to be treated the same across the board. So to give an example of separating non-lease components, if the company rents a truck, say the fair value is $100,000, and a trailer with a fair value of $50,000, this also includes maintenance for 5 years for a total of $100,000. The truck and trailer are identified as lease components. The maintenance is what will be identified as your non-lease component in this case. And the insurance and registration on the truck and trailer would be non-components in this instance. So for this exercise, if we elect the practical expedient, the lease would be allocated between each piece of equipment, and the maintenance is not considered to be a separate item. So we'd only look at the fair value of the truck and the trailer, which was $150,000 combined for a $100,000 contract, and we would allocate it pro rata across those two to give us an allocated value for each asset. Now, let's consider the same example, but we do have what's considered an observable standalone price, which is how we determine the separate pricing and value of non-lease components. But we have an observable standalone price for the maintenance for each item. So in this case, we would first take the lease and first allocate it to the lease and non-lease components. And then second, we would then allocate it between the components based on their fair value, and then down to the non-component items as well. So first we would look at the allocation between the fair value of the assets and then the maintenance. So we have values for the truck, trailer, and the maintenance. So first we would allocate between the lease and the maintenance. So out of 165, we then allocate 90,900 to the lease and 9,100 to the maintenance. And then from there, we would then allocate to each item under that. So then we would allocate that 90,900 between the truck and trailer based off the $150 fair value we had previously. And then the maintenance allocation, the $9,100 based on the 10 and 5 as previously noted, to give us the allocation between each of those components for recording purposes.
Okay, so now that we've covered the lease classification, let's discuss measurement. That is, how much is recorded for the lease. Before you can measure the lease asset and liability, you need to determine the lease term. This graphic shows the considerations that go into that determination. First, the lease term includes the non-cancelable period, and this should include any free rent periods before the lessee first starts making lease payments. Second, the lease term includes the renewal periods that are reasonably certain to be exercised. Again, there's that, quote, reasonably certain threshold that needs to be met. Third, the lease term includes periods where it's reasonably certain that a termination option will not be exercised. Finally, the lease term includes any optional periods where the lessor has control of deciding whether to terminate the lease. Regarding lease terms, it's common for some leases to have month-to-month arrangements. Those are also sometimes referred to as evergreen leases, and there's some considerations on this slide about an appropriate lease term for those evergreen leases. For an example of asset-based factors, an entity should consider the leasehold improvements on the leased asset and what it means if there's an estimated useful life of 10 years on those leasehold improvements, but the lease is being renewed on a month-to-month basis. In that situation, the entity may determine the evergreen lease has a lease term of 10 years. Once the lease term is determined, then the entity needs to calculate the payments that will be made during that lease term. As shown in the yellow boxes, these are the payments that should be included in the calculation of lease payments. This includes fixed payments, variable lease payments based on an index or rate that's measurable at the lease commencement, such as a minimum % increase each year. It also includes the exercise price of purchase option that's reasonably certain to be exercised, as well as termination penalties, fees paid to special purpose entities, and finally the residual value guarantee. As shown in the white boxes, these are the payments that should not be included in the calculation of lease payments. This includes the variable payments based on an index or rate that's not measurable at the lease commencement, such as changes in the consumer price index each year. It also excludes the guarantee of debt on the lease asset, as well as amounts allocated to non-lease components. Let's go through an example to illustrate the concepts about how to measure the future lease payments. Company P leases a car for 2 years and has 2 different payment options. The first option is to pay a fixed amount every month of $250. The second option is to pay 25 cents per mile driven with a minimum payment of $100. Also, the company can choose the payment option at the beginning of each month. In this example, how should the lease payments be calculated? Also note that this example highlights a concept in topic 842 of, quote, in substance fixed payments. These are payments that may appear to be variable, but have an element to them that is unavoidable. In this example, the second option would be an in substance fixed payment because there's a minimum payment of $100. So ASC topic 842 will tell you that you need to use the lesser of the 2 payment options. In this case, that's the $100 payment option. So when the company uses the second payment option that includes both fixed and variable payments, the company should exclude the variable payments of 25 cents per mile driven from its calculation of the future lease payments. This is excluded because the variable payment is not tied to an index or rate. So now the lessee has determined the lease term and the lease payments, and can use that information to calculate the lease liability based on the present value of the future lease payments. Keep in mind the keyword there is future, since any payments that were already made should not be included in the liability, as those amounts will be recorded as an expense, or maybe even as a prepaid expense. The present value is calculated using a discount rate, but there's some latitude in which rate can be used. If known, the lessee is required to use the rate implicit in the lease. However, if that's not readily determinable, then the lessee should use its incremental borrowing rate, or IBR. And we'll have more to say about the IBR later in this training. Once the lessee has calculated the lease liability, then it can determine the ROU asset amount. It's simply the lease liability plus the initial direct costs plus prepaid lease payments less any lease incentives received from the lessor. Regarding the initial direct costs, keep in mind those are only the costs that are incurred if the lease is signed. This is similar to contract costs under ASC Topic 606. So do not include any attorney's fees that were incurred in negotiating the lease, as those were incurred regardless of whether the lease was ultimately signed. Examples of initial direct costs would be lease commissions or payments to an existing tenant to incentivize them to terminate the lease. Initial direct costs do not include general overhead, advertising, or even allocating a portion of the salaries for the employees involved in negotiating the lease. Regarding lease incentives received, this could include a tenant improvement allowance or the lessor's reimbursement of taxes or moving costs. While this may seem confusing, I think an example will help illustrate the concept. Assume a company leases a machine for 5 years. The lease requires annual payments of $15,000 with step increases of 2.5%. There's no transfer of title, no bargain purchase option, and no residual value guarantee. The company's incremental borrowing rate for a similar arrangement and term is 6.5%. There's initial direct costs of $750, and the company receives an incentive payment of $2,500 from the lessor. Based on the annual payments of $15,000 and step increases of 2.5%, the company can forecast the lease payments required under the contract, and that totals $78,844. Using the company's IBR of 6.5%, the present value of the future payments is $65,328. So continuing with the same example, the lessee calculates the ROU asset to be $63,578. This is based on $65,328 for the present value of the lease payments, $750 for the initial direct costs, and less $2,500 for the lease incentives. When recording the lease in the accounting system, the lessee recognizes an ROU asset of $63,578, cash received of $2,500, cash paid of $750, and a lease liability of $65,328. One of the areas that can be tricky in Topic 842 is variable payments. As you may recall, sometimes they can be included in the initial measurement of the lease, and sometimes they're excluded from that initial measurement. So now we're going to explain how to handle variable payments in more detail. If the variable lease payment is based on an index or rate at the lease commencement, then it's fine to include those variable payments in the future lease payments. The key issue is the variable payments are known at lease commencement. For example, if the lease includes annual increases based on changes in the consumer price index, then those are excluded from initial measurement of the lease. However, if the variable payments are based on the prime rate at lease commencement, then those would be included in the initial measurement of the lease. Also, the lease is not remeasured for any changes to that spot index or rate. So if the prime rate changes subsequent to the lease commencement, then that does not change the calculation of the lease payments for the ROU asset and liability. However, if something else changes in the lease terms, such as the lease term is extended, then the lease would be remeasured and the prime rate at the remeasurement date would be used. Now, this may still seem a little confusing, so let's move on to the next slide and go through a couple examples. In our first example, a company leases a building for 10 years. The lease payments are made annually, but will increase based on changes in the CPI, which is 125 at lease commencement. The company does not know the implicit rate, and its IBR is 8% for a similar payment stream and similar collateral. Also, bear in mind this example is intentionally kept simple and ignores initial direct costs. It also assumes that an operating lease, as a 10-year lease for real estate, is probably not a significant part of the building's estimated useful life. At the commencement date, the company makes the initial lease payment of $100,000. Again, keep in mind that Topic 842 says that the initial measurement includes future lease payments. As that first $100,000 payment is made at lease inception, it's excluded from the calculation of the lease liability for the remaining 9 payments of $100,000. So the company calculates the present value of the remaining 9 payments using an IBR of 8% and that works out to $684,689. That's the lease liability. Then the company calculates the ROU asset amount as the lease liability of $684,689 plus the prepaid lease payment of $100,000. So the ROU asset amount is $784,689. Lastly, recall that this is an operating lease and the lease expense is recognized on a straight line basis over the lease term. So that means the company will recognize $100,000 of rent expense every year for 10 years. Now at the end of year one, the CPI has increased from 125 to 128. That's a 2.4% increase, and the annual lease payment increases from $100,000 to $102,400. Because the company does not have another reason to remeasure the lease liability, it cannot make an adjustment to the lease liability simply for the change in CPI. So the company will recognize $100,000 as fixed lease expense and $2,400 as variable lease expense. Now, on a side note, I'm referring to the $100,000 and $2,400 as separate amounts because the disclosure requirements in ASC Topic 842 will have these amounts separately stated in the footnotes. So, in this example, the company may want to modify its chart of accounts to easily track these separate amounts in different GL accounts. Now, let's go through one more example on variable lease payments. A company leases retail space for 5 years and there's no renewal options. The company's IVR for similar payment stream and collateral is 7%. The company classifies the lease as an operating lease, and there's annual payments of $100,000 with CPI bumps. This slide shows the lease amortization table with each of the 5 annual lease payments, which are increased based on changes in the CPI. In the column heading liability, the lessee measures the liability at the present value of the 4 remaining payments by using the base amount of rent at lease commencement, since the initial payment was made on January 1 with the lease commencement date. The effect of the CPI was not included in the initial measurement of the liability because the variable payments are based on changes in the CPI rather than a specified index or rate. The lease liability and the ROU asset are not remeasured as a result of changes to the CPI. In the column heading total expense recognized on the right side, the total lease expense recognized includes both the fixed lease expense and variable lease expense for the change in the CPI for the year. On the ROU asset column on the far right, the ROU asset is measured at the present value of the lease payments at the commencement of the lease, that is, the present value of 4 payments of $100,000 plus $100,000 of the prepaid rent. In subsequent years, the ROU asset is amortized in a manner consistent with operating leases. That is, amortization expense is calculated as a fixed lease expense less interest. So, to summarize the initial and subsequent measurement under Topic 842, the lease is initially measured with a ROU asset based on the lease liability and initial direct costs, but reduced for any lease incentives received. The lease liability is measured using the present value of the future lease payments, and the discount rate should be the implicit rate, but the IVR or risk-free rate can be used. After lease commencement, the lease is subsequently measured by amortizing the ROU asset using the straight line method, and the lease liability is amortized using the effective interest method.
In the initial measurement phase, and looking at commencement date, this is considered the date in which the lessor makes the underlying asset available to the lessee, and for which the lease classification is determined and the lease would be initially measured. Now, need to consider that commencement date may differ from the date stated in the contract and is not affected by when the actual lessee must start making lease payments. An example of this is if the lessor grants the lessee a rent holiday, such as the first 3 months are free or no payments are due for the first 3 months. And when the lessee actually expects to use or actually does start using the underlying asset. So if they have the right to enter and use it, that is what we consider the commencement date, even if they do not plan to move in there or start using it for another, say, month or 2, or even up to a year. Now, for accounting purposes, it is possible that a lease could commence before the beginning of the actual fixed non-cancelable term stated in the lease agreement. So if they do give you the right of excess use benefit before the non-cancelable lease term starts, that would actually be considered as your commencement date. As an example, the lessee agreement for the office space is signed January 1st of the first year. The fixed non-cancelable terms begin June 1st of the first year, and that's when the lessee is going to start making lease payments. Under the terms of the lease agreement, the lessee is granted access to the office space to start making improvements beginning on March 1st of the first year. In this situation, the lease term actually does commence on the date that the lessee is granted access, and that would be the March 1st. Now, if you have master lease agreements, even if it dictates the minimum dollar value for a number of units, the addition of additional items does not constitute a modification. Each unit is added to consider a separate lease component and assessed separately, which could result in you recognizing multiple commencement dates under one overall lease agreement. Now for the initial measurement of discount rates. An entity would use a discount rate to calculate your present value of your lease payments when you're determining what your lease classification is. Second, to measure the lessee's lease liability. And third, when you're measuring the lessor's net investment in the lease for sales type and direct financing leases. You're going to use this discount rate as a lessee and lessor, and that's determined on the basis of information as of the lease commencement date. If you're the lessor, it would be the implicit rate in the lease. If you're the lessee, you would use the incremental borrowing rate to determine that discount rate. Now, as part of the lease inception, the lessee must develop a discount rate to calculate the present value of the payments, to determine the lease classification, and how to measure the lease liability. When determining the discount rate to be used, one, you would use the implicit rate in the lease unless that rate cannot be readily determined. And when there's no implicit rate available or not readily determined, you would use the entity's incremental borrowing rate. You would consider this by obtaining a quote from a lender or have it calculated by a specialist. Now, instead of going through that process, you do have an option to make a policy election as a private company. Now, one thing I do have to say about this is when many people may look at it and want to shortcut by noting that the interest rate on a line of credit or an unsecured debt would be reflective of the incremental borrowing rate. Under 842, that is not considered acceptable for the use of an incremental borrowing rate because it does not match the same terms and underlying asset guarantee or securitization as you would in a lease type of an finance arrangement. So incremental borrowing rate in itself is the rate of interest that a lessee would have to pay to borrow on collateralized basis over a similar term, an amount equal to the lease payments in a similar economic environment. And to evaluate the collateral considered for the borrowing as followed. You would start with a rate that is obtained from a general unsecured with recourse borrowing and should adjust that rate for the effects of collateral. Assuming a full collateralization and not assuming an under or over collateralization position. The collateral considered does not have to be that specific leased asset. It can be the leased asset, but it also may be any form of collateral that a creditor would be expected to attempt or accept to secure a borrowing of a similar term. That is collateral that is at least as liquid as the leased asset. As I mentioned before, for non-public companies, you do have a private company policy election allowed. So for this, instead of determining your incremental borrowing rate, you could use the risk-free discount rate, which is provided by the federal government. in lieu of determining your incremental borrowing rate. Usually the U.S. Treasury risk-free rate is the closest rate to use, and you use it as a date closest to the commencement date for the period closest to the expected life. So for an example of this is if you have a lease life of 6 years signed on, say, a Saturday, the suggestion to use is Friday's rate for a 7-year life if the rates for 6 years on Saturday, as of the commencement date, is not considered available. For the consideration of initial direct costs, the incremental cost of a lease that would have not been incurred if the lease had not been obtained is what's considered an initial direct cost. This usually includes things such as commissions or payments made to existing tenant to incentivize that tenant to terminate its lease, or payments made to prior landlords to terminate old leases once the replacement lease is reasonably certain to be entered into. There are other things that many people may consider to be initial direct costs that under 842 are not actually considered initial direct costs. So the cost to negotiate or arrange a lease that would have been incurred regardless of whether the lease was obtained, such as fixed employee salaries, obtaining tax or legal advice on the contract, or negotiating lease terms and conditions, are not considered initial direct costs under the new lease guidance. General overhead expenses, such as depreciation, occupancy, and equipment costs, unsuccessful origination efforts, and idle time, are not items that are considered initial direct costs under the new guidance. And costs related to activities performed by the lessor for things such as advertising, soliciting for potential lessees, servicing existing leases, or other ancillary activities, again, are also not considered initial direct costs under the new guidance. Once you have gone through and determined what you can capitalize, you would then allocate those capitalized costs between your lease and non-lease components if you did break them out, or unless you made the policy election to not allocate, then you would not have to go through that step. And then you would amortize those costs ratably over the lease term as part of the total lease costs. You would include these unamortized amounts in the measurement of the right of use asset. So you would not record it as a discount on the debt, but you record it as an increase in the right of use asset at the date of commencement.
So now that we've provided the rules in topic 842, let's go through some examples. In our first example, there's a contract for a fiber optic cable, and the customer has 3 dedicated fibers for 5 years. As this arrangement gives the lessee the right to control usage of the fibers, the contract would contain a lease. In the second example, there's a similar arrangement for a fiber optic cable, but in this example, the customer has guaranteed bandwidth equivalent to 3 dedicated fibers for 15 years. While there's similar capacity as the first example, there's no identified asset that's under the customer's control, and accordingly, the contract does not contain a lease.
For this third example, we're looking at a retailer who enters into a 5-year agreement with a mall operator. It includes a 3 5-year lease renewal option. The rent payments are going to be $5,000 a month plus 1% of sales during that initial term, and the base rent is going to grow 10% in each renewal period. The retailer is going to incur costs of $100,000 in installing leasehold improvements to customize the space to its brand requirements. The leasehold improvements will have an estimated useful life of 8 years. In this instance, we'd consider that the lease term is going to be 10 years, which is the initial 5-year lease term, plus the fact that we have leasehold improvements of 8 years would mean we would have to do at least 1 renewal period to gain the full value of those leasehold improvements. So the expected life is going to be the first lease term plus 1 renewal option. As we would expect that the retailer would incur an economic life on those leasehold improvements if they did not exercise at least the first renewal option. Now, the percentage rent is considered variable and will be excluded from the lease payment calculations. Instead, the percentage rate is going to be expensed as incurred. So that 1% of sales would be expensed as it was incurred. In this example, lease payments would total $630,000. So that'll be $300,000 for the base year or base lease term, plus $330,000 for that renewal term. For this fourth example, our facts are that we have a 10-year lease with an option to extend for an additional 5 years. The lease property is going to be $50,000 a year for the base term. The renewal period is going to be $55,000 a year. We do not have a reasonably certain expectation to exercise the option to extend. So our lease term in this case is going to be calculated based on 10 years. The payments are due at the beginning of each year. Our initial direct costs in this case were calculated at $15,000. We've determined an incremental borrowing rate of 5.87%. And the present value of the remaining lease payments after the first year rental and initial direct costs comes out to $342,017. In this instance, we will record the following entries as a reflection of this lease agreement. At the date of commencement, we'd have a right of use asset of $407,000. We would have a lease liability of $342,017. We'd have the cash paid out for the first lease payment of the $50,000 per year. And we'd have the cash out for the initial direct cost of $15,000. Now, when we're recognizing the lease expense during the first year, if this was considered a finance lease agreement, we would recognize amortization of $40,702, which is the right of use assets divided $407,000 divided by the 10-year term. We'd reduce our right of use asset by that same amount. We'd record an interest expense for $20,076, and we'd increase our lease liability for $20,076. If we were doing this as a operating lease, we would record a lease expense of $51,500. We would record a lease liability increase of the $20,076 to reflect the increase in interest expense, and we would reduce our right of use asset by $31,424. If we look at how the actual expense is recognized over time for the life of a lease between a finance and operating lease, you'll see that for a financing lease, we'll have a higher expense in the beginning of the term, and will slowly decrease to have a lower expense towards the end of the lease term. Well, as for an operating lease, you should see a relative straight across the board expense period over period. The concept behind this is a financing lease, you're getting more benefit of ownership and you're having a higher decrease in the value of asset in the beginning of the lease terms versus the end of the lease.
Now, the accounting world would be a lot simpler if lessees never made changes to leases, but we all know that happens. So let's talk about lease modifications. Keep in mind that not all changes to lease agreements would be considered a lease modification under GAAP. It really only applies to changes in either A, what is being leased, or B, how much is being paid for that leased asset. After determining that the change to the lease terms meets the GAAP definition for a lease modification, the next step is to consider whether the modified contract is still a lease or contains a lease. If so, then consider whether it's A, a new deal, or B, the old deal but with changes. Also, keep in mind that there are some changes in leases that won't qualify as a lease modification. For example, exercising a purchase option or a renewal option is not a modification, as those rights existed in the lease agreement. That is, there wasn't a change to the lease terms. Also, changes in what's assessed to meet the quote reasonably certain threshold is not a lease modification. Now, this slide and the next slide both show the complexity with lease modification accounting. Under ASC Topic 842, it basically comes down to whether the changes to the original lease agreement result in a new lease or an old lease with changes. If it's considered to be a new lease, then bifurcate into two leases with the original lease and the new lease. If it's considered to be an old lease with changes, then the lease is remeasured. Here's the rest of the flow chart from the previous slide. Again, it just shows how complex lease modifications can be. As I mentioned, the key issue is how you determine whether it's a new lease or an old/modified lease. When going through lease modifications, you'll need to determine if the lease modification should be accounted for as a separate contract. This happens when the modification grants the lessee a new right that was not in the original lease agreement, and there's an incremental increase in lease payments that's commensurate with that new right. If the modification does not meet both of those previous criteria, then the modification is not accounted for as a separate contract. That means reassessing whether there's still a lease. If so, the lessee needs to reassess the lease classification at the modification date. Continuing from the previous slide, a modification that is not a separate contract means reassessing the lease classification at the modification date. This includes the remaining economic life of the lease asset, fair value of the lease asset, the discount rate, the remaining lease payments to be paid over the lease term, including any unamortized lease prepayments. So I mentioned on previous slides that a criteria for lease modifications to be treated as a separate contract is when there's an increase in lease payments. But what if the lease is changed so that the lease payments decrease? Specifically, the lease is shortened. For example, what if a 10-year lease is changed in year 3 from 10 years to 6 years? So at the modification date, the lease is changed from having 7 remaining years to having 3 years left. If that's the case, then the lessee remeasures the lease liability using the remaining lease payments and discount rate in effect at the modification date. Also, initial direct costs, lease incentives, and other payments are treated in the same way in a lease modification as they be treated at lease inception when initially measuring the lease. One unique area related to lease modifications is reference rate reform. While this term may be new to some people listening to this training, it simply refers to LIBOR being discontinued and how it's being replaced with another rate in the contracts, such as the prime rate. There were concerns that changing the interest rate simply because the capital markets are discontinuing LIBOR would accidentally cause work analyzing lease modifications. The FASB did not intend for that to happen, so ASC Topic 848 was created to assist entities that have contracts referencing LIBOR. ASC Topic 848 basically says that if a contract is modified simply to switch from LIBOR to another reference rate, then the parties can bypass the lease modification analysis. This is a huge time saver. The key is that there cannot be any other substantive changes. That means some minor stuff could change, like the address or an executive's name, but nothing important that would change the rights under the lease. If the lease is modified and some important things are changed beyond the reference rate, then it must go through lease modification analysis. There's one last area for lease modifications that needs to be discussed. That's the lease concessions related to the COVID-19 pandemic. In some instances, leases were modified so that payments were deferred for several months. In other instances, the lease payments were totally forgiven. The FASB received lots of questions about how to handle those lease concessions, and they issued a staff Q&A document to help entities with these transactions. Under both topics 840 and 842, the FASB says that a lessor always has the implied right to defer or forgive payments. So lease concessions could skip modification accounting because there's no new rights that were not already present in the original lease. Using the example on this slide, the 10-year lease is amended due to the COVID-19 pandemic, and the lessee pays a one-time fee to reduce the lease term to 5 years. Under topic 840, the lessee expenses the lease payment when it's paid. Under topic 842, the lessee defers the expense on a straight-line basis over the remaining lease term of 5 years.
For lease concessions, especially as it relates to COVID-19, if an entity receives or is provided a lease-related concession to help mitigate the economic effects of COVID-19, you need to consider whether or not to elect to not evaluate those concessions provided by the lessor as relates to the effect of 19 as a change in the provisions of the lease. FASB staff issued a Q&A document that states that entities can elect not to evaluate whether a concession provided by the lessor to the lessee in response to 19 is considered a lease modification. The FASB staff basically said that an entity that makes this election can elect to apply the lease modification guidance to that relief or account for the concession as if it was contemplated in the existing contract itself. So it eases the process of evaluating lease modifications through concessions related to COVID-19. So if we elect to not evaluate whether lease-related relief the lessor provides to mitigate the economic effects of COVID-19 on lease is considered a lease modification. Instead, the entity would elect not to evaluate whether a concession is considered a modification. They can elect whether or not to apply the modification guidance. So if they assume the relief was always contemplated by the contract or assume that the relief was not contemplated by the contract, they can choose an approach from either way. And both the lessor and the lessees could make this election, and they do not have to be tied to each other. So the lessor can make a different decision than a lessee could for the same lease.
Let's now discuss issues for lessors in topic 842. While there's some big changes in topic 842 for lessees, there's much fewer changes for lessors, and most of those relate to disclosures. However, the changes should not be dismissed, as they may require changes to accounting systems in order to comply with GAAP, and those changes may also impact internal controls. One minor difference between topics 840 and 842 is the leveraged lease model is no longer allowed in topic 842. As it relates to the remaining 3 accounting models, they're all relatively consistent with topic 840. First, you start with the criteria for sales type leases, and then consider the criteria for direct financing leases. If neither of those criteria are met, then the lease defaults to operating lease. For sales type leases, the criteria includes the transfer of ownership, the lease term covers a major part of the economic life of the leased asset, or the present value of the lease payments exceeds the fair value of the lease asset. That is, there's profit on the sale of the leased asset. Also, it could be a sales type lease if the leased asset is so customized it has no alternative use. For direct financing leases, use that same present value calculation in the sales type lease analysis, but now include any residual value guarantee. If the present value of those lease amounts equals or exceeds the fair value of the leased asset, then it's accounted for as a direct financing lease. After determining the proper lease classification, a lessor then needs to follow the accounting treatment in topic 842. For sales type and direct financing leases, the lessor removes the leased asset from its balance sheet and recognizes a receivable for the future stream of lease payments. For sales type leases, the profit is recognized at lease commencement. As Topic 842 follows the control concept in Topic 606, the lease commencement is when control transferred to the lessee. If there's a loss on the lease, then that's recognized at lease commencement as well. As both sales type and direct financing leases start with recognizing the present value of the lease payments, which is based on the implicit rate, there's an interest component that's recognized using the effective interest method over the lease term. For operating leases, the lessor keeps the lease asset on its books and just recognizes the lease activity as it's incurred. That includes the rent receivable, security deposit liability, deferred rent, and so forth. For the income statement, the lessor recognizes the lease revenue on a straight line basis over the lease term. Before deciding the lease is a direct financing lease, consider these issues. Topic 842 does not preclude the sales type classification because there's uncertainty about the collectibility of lease payments. Topic 842 doesn't preclude the sales type classification because there's unreimbursable costs. And lastly, Topic 842 does not preclude sales type classification because most of the lease payments are variable.
For lessors, as it relates to the new guidance, initial direct costs under 842 includes only incremental costs of a lease that would not have been incurred if the lease had not been obtained. This is a little bit more narrower than the previous examples under old lease accounting. And the deferment or recognition will depend on the type of lease that is being entered into. Our costs that we would include as initial direct costs in our lease calculation would be commissions or payments made to an existing tenant to incentivize that tenant to terminate the lease. We would not include, or we would exclude, items such as legal fees, the cost of evaluating the lessee's financial condition, the cost of negotiating lease terms, and general overhead. As an example of lessor accounting for initial direct costs, assume the lessor incurs the following costs.
Now let's cover some other nuanced changes in Topic 842. First, let's consider if the lessor actually sold the leased asset to the lessee. The concept of a sale is now consistent with Topic 606. Which means that control needs to transfer to the lessee as well as the other criteria in Topic 606 must be met. If those criteria are not met, then it's not a sales type lease and direct financing treatment should be considered. Second, the concept of executory costs no longer exists under Topic 842. Executory costs include maintenance, taxes, and insurance. For maintenance, this is the non-lease service component under Topic 842. For property taxes and insurance, they're accounted for based on who pays those costs. If the lessor pays the taxes and insurance, then it's recognized on a gross basis in the income statement, which means the lessee's reimbursement for those costs are included in revenue. If the lessee pays the taxes and insurance directly to the third party, then the lessor does not recognize them in the income statement. Now let's go through two examples of how lessor accounting works under Topic 842. In example 1, there's a 6-year lease of equipment with annual payments of $9,500 due at the end of each year. There's also a residual value guarantee of $13,000, and the lessor expects the equipment will be worth $20,000. When the lease starts, the lessor's records show the equipment has 9 more years left in its useful life and a net book value of $54,000. There's no title transfer to the lessee, nor a purchase option. The lessor incurs $2,000 in initial costs to get the lease signed, and the implicit rate is 5.48%. So how should the lessor classify this lease? Okay, let's break down that information on the previous slide. The fair value of equipment is $62,000, and that's used as the net investment in the lease. The lessor calculates the sum of the present value of the lease payments and residual value guarantee using the implicit rate, and that works out to $56,920. The lessor also expects to have a lease asset with some residual value that's not guaranteed at the end of the lease, about $7,000. And the present value of that additional residual value is $5,080. So the lessor expects to get $56,920 in consideration from the lessee and also expects that $48,920 of value will be consumed during the lease. So there's actually a profit on the lease of $8,000. So the difference between the value, and that's the difference between the value derived from the lease and the consumed during the lease. Lastly, the initial direct costs don't factor into the profit calculation because the fair value of the equipment is different than its carrying amount. So those costs are expensed at lease inception. The lessor should treat this as a sales type lease because there's a profit of $8,000 on the lease. As a reminder, the lessor needs to use the implicit rate when calculating the present value, and the initial direct costs are not included in those calculations. So on day one of the lease, the lessor removes the equipment from its books and recognizes the lease investment. So the lessor debits the lease investment for $62,000, credits the equipment for $54,000, and credits the selling profit for $8,000. The lessor also recognizes an expense of $2,000 for the initial direct costs. At the end of the first year, the lessor receives a $9,500 lease payment and recognizes $3,400 of interest income, as well as reduces the lease investment by the difference of $6,100. Note that the lessor may need to set up GL accounts to track the separate components of the lease investment, that is, the lease receivable and the unguaranteed residual value. The lessor amortizes the separate components of the lease investment of $62,000, which includes the lease receivable of $56,920 and unguaranteed residual asset of $5,080. In doing this, the lessor starts with the lease receivable of $56,920, which you may recall is the present value of the lease payments and residual value guarantee, and amortizes $63.80 of that receivable balance. However, the balance of the unguaranteed residual asset needs to increase over the lease from $5,080 to $7,000. So there's interest income of $280 that's recognized. Thus, the net of the $6,380 of amortization of the lease receivable and $280 of unguaranteed residual asset is $6,100, as shown on the previous slide. Following this amortization methodology will ultimately result in a residual value guarantee of $13,000 and the unguaranteed residual asset of $7,000 being combined to the $20,000 expected fair value at the end of the lease.
So now let's go over this example. For example 2, we're going to assume the same facts as we had as the sales type lease in example 1, except that the $13,000 residual value was provided by a third party. In this case, none of the criteria to be considered a sales type lease were met. So in this case, the lessor would classify the lease as a direct financing lease because the sum of the present value of the lease payment and the present value of the residual value guarantee by the third party amounts to substantially all of the fair value of the equipment. It is probable that the lessor will collect lease payments plus any amount necessary to satisfy that third-party residual value guarantee. For this, we're also going to use a discount rate of 4.646. So at the commencement date, the lessor is going to de-recognize the equipment and recognize a net investment in the lease of $56,000. Which is equal to the carrying amount of the underlying asset, which was the $54,000, plus the initial direct costs of $2,000 that were included in the measurement of the net investment in the lease. The net investment in the lease also includes the lease receivable of the $58,000, which is the present value of the 6 annual lease payments of $9,500, plus the third-party residual value guarantee discounted at the rate we noted of the 4.646. The unguaranteed residual value would be $5,331, again, which is the present value of the difference between the estimated residual value of 20 and the third-party residual value of the 13,000, again discounted at the 4.646, which would give us a deferred selling profit of 8,000. So you can see we have our lease receivable gross at 58,669, less the carrying value of the equipment of 54,000. Plus the unguaranteed residual value of 5,331, less the indirect cost of 2,000, which gives us our deferred selling profit of the 8,000. At the end of the first year, the lessor is going to recognize the receipt of the lease payment of $9,500 and the interest on the net investment of the lease of the $4,624, which is the beginning balance of the net investment of the lease of $56,000 times the discount rate that at the commencement date would have resulted in the sum of the lease receivable and the unguaranteed residual asset equaling $56,000, which is the 8.258, resulting in a balance in the net investment in the lease at the end of the year of $51,124. Also, at the end of the first year, the lessor is going to calculate, for disclosure purposes, the separate components of the net investment in the lease receivable, and the unguaranteed residual value, and the deferred selling profit. At the end of year 6, the lessor is going to reclassify the net investment in the lease, which should then be equal to the estimated residual value of $20,000 back as equipment. The lease receivable would be equal to $51,895, which is the beginning balance of the lease receivable minus the annual lease payment that they received of the $9,500, plus the amount of interest income on the lease receivable during that first year, which is $2,726, which is basically the interest rate we've already determined times the initial balance. For determining the unguaranteed residual value at the end of that first year for disclosure purposes of the $5,578, we take the beginning balance of the residual, we add in the interest income on it, which is again using that 4.646 rate of to give us 247, plus that initial balance of 5331 gives us the ending balance of 5578. For the deferred selling profit at the end of year 1, we're going to start with the $8,000 balance, and then we're going to subtract out the amount recognized during the first year, which is $1,651, which is the difference between the interest income recognized on the investment during the first year of the $4,626, and the sum of the interest income earned on the lease receivable and the unguaranteed residual value during that first year. For disclosure purposes for the lessor, we break it down into two sections, qualitative and quantitative. For qualitative disclosures, we're noting that we need to disclose significant accounting judgments and estimates as we use them, information about the nature of the leases, such as the nature of any variable lease arrangements, or any termination dates, any renewals or purchase options that are available. We'll also include information of how the lessor manages its residual asset risk and include information about any residual guarantees if there are any included in the lease. On a quantitative basis, we're going to disclose maturity analysis of the lease receivables for sales type and direct financing leases and of lease payments for operating leases. We're going to also cover the selling profit or loss recognized at lease commencement and interest income for sales type and direct financing leases. We'll also disclose the operating lease income as well as variable lease income. As a lessor for sample disclosures, we've included a couple examples in here. So I'll give you a minute or so to read over this. When looking at subleases, you're considering the lease broken down really into three components. For the original lease, you have what's the lessor and the original lessee, and that would be called the head lease. And then you have the agreement between the original lessee, which is now the sublessor, and the final lessee or sublessee in this instance. When looking at this, if we have instances where the original lessee is relieved of the primary obligation, it's not considered a sublease. So if the original lessee is relieved, these are actually considered to be termination of the original lease, and the lease-related assets and obligations would be derecognized by that sublessor. Any consideration paid or received upon termination that was not already included in lease payments, such as a termination penalty that was already not baked into the lease payments, is included in the gain or loss on the termination of the original lease. If the original lessee remains secondarily liable for the original lease, the guarantee obligation is recognized by the lessee in accordance with FASB ASC 405. That is basically, it'll be measured at fair value and included in the determination of your gain or loss on the lease termination. If the original lessee enters into a sublease or sells or transfers the original lease to a third party, the original lessor does not change its accounting for the original lease. However, if the original lease agreement is replaced by a new lease agreement with a new lessee, the original lessor accounts for both the termination of the original lease and the new lease as separate transactions. For the sublessee, it would continue to assess its lease obligations under ASC 842 for the recognition and measurement provisions. The sublessee would classify the sublease by referring to the underlying asset rather than by referring to the right-of-use asset arising from the original head lease. Again, the sublessee would only look at their direct transaction itself. They would not step through to the other lease agreement that could be sitting on top of it. From a sublessor standpoint, if the underlying asset is released by a lessee to a third party and the original lessee retains the primary obligation of the original lease, the transaction is a sublease. The sublessor assesses the sublease classification independently of the classification assessment that it makes as the lessee of the same asset. So basically, they would be considered two separate agreements and treated separately regardless of the overall economics between the two. So you would treat your lease as lessee under your normal 842 consideration, and then you would treat your sublease as sublessor as just a normal lessor-lessee arrangement. When a sublessor enters into sublease arrangements and determine that the term of the sublease, which includes any non-cancelable term and any lease renewal options that are reasonably certain to be exercised by the sublessee or that are controlled by the sublessor, is considered to be longer than the lease term of the original head lease, the sublessor is required to reassess the lease term of the head lease in accordance with guidance in 842. However, the existence of the renewal option on its own does not result in the head lease being extended. So that needs to be given consideration, is to look at what's reasonably certain for the sublessor to renewal and whether or not they're going to renew or there's reasonably certain that they're going to renew, how that would impact your head lease and your options under the head lease for the overall life of both the lessor and lessee arrangement and calculation. If you have a sales type lease, any selling profit would be recognized at the sublease commencement date. That is the date in which the sublessor makes the underlying asset available for use to the sublessee. If the sublease is considered a direct financing lease, the selling profit would be deferred and recognized over the expected life of the sublease. Again, this is going to be straightened the same terms as if you were a lessor treatment. Now, for presentation purposes, there is no clear guidance on what usually should be recognized as separate contracts and accounted for separately. But usually that would be the preferred presentation method, is to present them as separate contracts and accounted for separately. There is some diversity in practice that exists. Other forms of presentation may be acceptable in certain situations. Regardless of that, though, there needs to be a requirement for disclosure of the sublease income on a gross basis and have it presented separate from finance or operating lease expenses, whether that's in the financial statements themselves or in your footnotes. In addition to making other lessor disclosures, 842 does require an original lessee sublessor to disclose the existence and terms and conditions of any residual value guarantees provided by the sublessee. And the sublease income, again, on a gross basis, that would be separate from your finance and operating lease expenses. For impairment considerations, the right-of-use asset is still subject to impairment testing. It could be reasonable to conclude that a sublease portion can be considered as a single asset. For example, if the original lessee may conclude there is no accounting difference between accounting for its lease of a 10-floor building as one lease component, which is basically considered the building, or 10 separate lease components, whereas the 10 functionally independent floors, depending on how the sublease is arranged.
Now let's discuss related parties and how that could impact lease accounting. The FASB considered whether there should be significant differences between leases with third parties and with related parties. They ultimately settled on an objective standard that the lease accounting should be based on the legally enforceable terms and conditions as stated in the contract. Keep in mind the FASB is not intending for legal counsel to be involved when determining that enforceable terms and conditions, but that may be needed in some situations. Also, the FASB followed another concept from topic 606, and that combining contracts should be considered. So the lease with a related party may be on a single page with very few terms, but a separate contract with the related party includes restrictions or other terms related to that leased asset. In those situations, the entity should consider the contracts together when determining the legally enforceable terms and conditions for the leased asset. So that means the FASB says that leases are handled the same regardless of whether the counterparty is related or not. However, it's common for related parties to draft a lease that's on a month-to-month basis, but those don't exist in most cases with third parties. So shouldn't there be a difference? The FASB says not really. It could be assumed that the lease would be renewed through the period needed to exhaust the useful life of the leased asset, such as tenant improvements, but that's about it. Another example of combining contracts is when there's a lease for a building that's on a month-to-month basis, but the mortgage note on the building requires the entity to lease the building while the mortgage balance is greater than zero. So in that example, the lease would be assumed to renew on a monthly basis through the end of the mortgage term. Final example is following the legally enforceable terms is a sale-leaseback transaction where the sale price is above market. Instead of recording at market or deferring the selling profit until the asset is ultimately sold to a third party, Topic 842 will say to record the sale-leaseback transaction based on the contract terms and disclose the details.
A sale and leaseback transaction involves a transfer of an asset by an entity, which would be considered the seller or lessee, to another entity, which would be classified as the buyer or lessor, and the leaseback of the same asset by the seller or lessee. So example of this would be you have a 20-floor building, 10 floor, in which the entire building's been sold. The original entity, which had sold the 20-floor office building, would then lease back 10 of the floors. This would be sale-leaseback accounting under the provisions of 842. Again, this can apply regardless of whether the seller leases back 100% of the asset or just 1%. So in this case, if they didn't lease back 10 floors, they just lease back an office or one of the floors, this would still be applicable. And this would apply to all assets that are within the scope of ASC 842. So this could include the sale of a legal entity when the assets leased back constitutes substantially all of the assets of the legal entity that is sold. So if you give consideration to where a legal entity has been set up, where all they do is hold assets for lease, if that entire entity is sold, which includes all the assets underlying it, it could still classify as 842. Also, this could apply to an LLC that holds only a building. If the entire LLC is sold and then the building's leased back. This would also apply among related parties as well. So if there's sale leaseback transactions between related parties, this could apply. So if there are instances where the company buys a building and then sells it to a related party LLC that it sets up and then leases it back for operations, this could actually trigger a sale leaseback accounting consideration. That would probably be the most common example of this as it relates to what I just talked about. Now, one of the things you need to consider when you're looking at a sale leaseback is, was there truly a sale? And in order to do so, you need to best go through this flow chart to give you an example of how to determine whether or not this is truly a sale or is a failed financing, what's called a failed sale, where it's considered a financing transaction instead and not considered an actual sale. So is the original transaction a sale under ASC 606? Did it actually transfer control of the asset to the buyer lessor? If it did, is the lease back classified as a sale lease type by the buyer lessor, a finance lease, or by the seller lessee? If it isn't, does the transaction include an option for the seller lessee to repurchase the asset? If it does the purchase option meet both the following conditions? One, is there the exercise price of the option and is at fair value of the underlying asset at the time the option is exercised? If there's alternative assets that are substantially the same as the transfer asset readily available on the marketplace. If it meets both of those, then we are in a sales leaseback transaction. If it does not meet those criteria, then we are in, again, a financing transaction, or also commonly called a failed sale. When you have a sale, if the transfer of the asset is a sale, the seller lessee does each of the following. It's going to recognize the transaction price for the sale in accordance with 606, so under normal revenue recognition criteria, at the point in time that the buyer lessor obtains control of that asset. It's going to de-recognize the carrying amount of the underlying asset, and it will recognize any gain or loss immediately, again adjusted for any off-market terms in the agreement. If the transaction is not considered a sale, then the seller lessee and the buyer lessor would account for it as a financing arrangement. So the seller lessee keeps the asset subject to the sale and sale leaseback on its balance sheet and accounts for amounts received as a financial liability in accordance with other GAAP. The seller would then decrease the financial liability by its lease payments made, less the portion considered interest expense. So basically, you would keep your asset on the books, you would record the cash coming in, and you record a liability for the initial cash coming in, and then amortize that off as the payments are made. The seller lessee, again, under no sale, would adjust the interest rate on its financial liability as necessary to make sure that both, one, the interest on the financial liability is not greater than the payments made on the financial liability, or the shorter the lease term, or the term of the financing. In other words, there should be no negative amortization of the liability at the end of the shorter lease term or the term of the financing. And as well, the carrying amount of the asset does not exceed the carrying amount of the financial liability at the earlier of the end of the lease term or the date at which control of the asset will transfer to the buyer lessor. Again, there will be no built-in loss. For impairment considerations, if the asset did not qualify for sale and leaseback, you would continue to assess for impairment under normal GAAP, which is ASC 360, as a held for use asset. If there's any excess of carrying value over fair value at the day of the sale, this would indicate the recoverability of the carrying amount of the asset should be assessed under that same consideration for impairment, ASC 360. Now, what happens when we actually have a different asset? So if the asset sold is not the same as the asset leased back, the transaction would be recorded as a sale and lease back if the sale and the lease were entered into as a single transaction first, and as well as if the assets involved would be required to be accounted for as a non-monetary exchange, such as if they had been exchanged for items that are essentially identical, and where the future cash flows are not expected to significantly change as a result of the exchange. There are other items to bring to your attention, certain miscellaneous items that could have potential impacts on the transaction. These are less common situations, but we do want to bring them to your attention because they do have an accounting impact on the overall treatment. So first is if there's a right of refusal and first offer, if the seller lessee guarantees the residual value, and if there's a contingent repurchase option.
Let's now move from the accounting details to how leases are presented and disclosed in the financial statements. On the balance sheet, finance and operating lease assets should be separate line items in the asset section. However, the finance and operating lease liabilities can be combined, but they need to be classified as current or non-current liabilities. On the income statement, finance leases are expensed as amortization and interest. For operating leases, the expenses are all reported as lease or rent expense. For the cash flow statement, operating leases are all included in operating activities. For finance leases, the interest portion of the lease payments is included in operating activities, and the principal portion of lease payments is included in financing activities. As it relates to disclosure requirements, Topic 842 says there should be enough information to enable users of the financial statements to understand the amounts, timing, and uncertainty, if any, of cash flows related to leases. Specifically, the disclosure should include the enforceable terms related to the lease term, contingent lease payments, renewal options, and similar items, as well as any judgments made when accounting for leases. If there's any executed lease agreements that have not commenced as of the financial statement date, then there should be disclosures about those leases as well. Also, keep in mind that these requirements apply to subleases too. When it comes to lease liabilities, there needs to be disclosures for operating leases and finance leases, including the future lease payments, weighted average remaining lease term, weighted average discount rate. For many entities that have more than 10 or 20 leases, they may find that purchasing a license for lease accounting software will be very helpful in aggregating the information for these disclosure requirements. Our firm is licensed SimpLease for lease accounting software. Now, while Topic 842 does not require a specific format, it does provide an example as shown on this slide. As you can see, there's a lot of information in this example that can take a good deal of work for lessees to prepare, and that's why lease accounting software can be so helpful. For example, when looking at the sample table, you can see there's a breakdown on finance leases between amortization expense and interest expense, as well as a breakdown of rent expense related to operating leases into the various required components, including lease expense on long-term leases, short-term leases, contingent lease payments, and sublease payments received. Depending on the materiality of some disclosure items, it may be appropriate to aggregate or disaggregate information so that it's meaningful to users of the financial statements. Also, lessees need to disclose any practical expedients in Topic 842 that were elected. To help understand the scope of the disclosure requirements, we also provided a handout with an example of the full disclosures required in Topic 842. Thank you very much for attending this training. We hope you found it useful. If you have any questions about it, please contact your partner or manager at Singer Lee Wack for further help. Have a great day.